Hi, everyone. This is Jason Birack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. And before we start talking about global macro, the dollar rally, the Fed rate hikes, and how that's affecting the global banking system, the private banks in Canada and emerging markets, we should just say that due to compliance issues, he's not going to use his real name. It's just Deer Point Macro. So let's get that out of the way first, right?
Yeah, exactly. Thank you, Jason.
Yeah, because people are going to be like, who is this guy? And it's like, well, due to compliance issues, want to make sure you keep your job because there's a lot of bankers being fired lately. Big tech companies, the banks, those guys are firing. Don't want you losing your job over a podcast.
Not unless you're giving me a job, but you gotta be careful now. Things are definitely slowing, especially in the financial sector.
Well, if I get a new business partner soon, that's a larger financial company, man. I think you're a good analyst. So we'll see. We'll see in the future, but not right away. I did have a couple of potential business deals done 6 months ago, but all of a sudden ghosting, no emails returned, no phone calls, no text messages back. Unfortunately, that's life.
Yeah, exactly. Exactly.
Okay, so we're recording this interview on Friday, November 17th, 2023. The dollar index is down a little bit, but it has rallied substantially in the last month or so. It's down a little bit to 103.8. I want to get your thoughts, though, on the lag effects of the dollar rally, Fed policy with the rate hikes on the private banking system outside the US in emerging markets in Canada. So how would you describe the state of the banking system with the dollar rallying and the interest rates? Is that really hurting these private banks outside the US?
I do think that it's going to start to put some pressure on private banks. I mean, as you've mentioned, we have started to see the Dixie start to come off over the last 2 days. I think a big point of that is, one, what we've gotten from the CPI and the PPI data. And so obviously now, again, we have the rates market starting to front run cuts. The curve has actually started to move in. I think like before it was maybe around August or July was the first anticipated rate cuts into next year. That's been pulled forward. Now you're looking at something around March. And so obviously, those things start to affect FX differentials, when you're starting to look at if the Fed starts to cut, but people like the ECB have to remain hawkish because of sticky inflation, or even the Bank of England has to remain continual hawkish because of stickier than anticipated inflation. So I think that's been a large driver. As for the banking sector, I do think that things could start again to worsen. And kind of what I've really been looking at is money market funds. Money market funds are, I personally think, a very important indicator of kind of dollar flows outside of the United States. And the reason is because if you start to look at banks that are obviously not American banks, they don't have this continued access to retail dollar deposits. And are very dependent on money market funds to kind of start to supply the finance for dollar assets. We've now seen French money market funds access some of the highest amount of dollars kind of in the wholesale dollar funding market in, I believe, the past 2 years. So we are starting to see somewhat stress in places like France. Obviously, you're starting to see that in places like China. So I do think that this is obviously at some point going to return kind of the push up in the Dixie, probably into the remainder of the year, just as demand starts to increase for dollars, whether that be through, outright spot transactions or kind of more complex derivatives, like, forward swaps, cross-currency basis swaps. I do think that those things are going to start to play a big role in trying to help continue funding these kind of dollar liquidity operations that a lot of private and foreign banks are doing behind the scenes.
Okay, so let me try to summarize this in easier to understand terms, because you mentioned a bunch of difficult terms that our listeners who are not hedge fund managers or bankers might not understand. So you think that all this capital inflows into money market funds, you think that's a red flag or warning signal, and we've started to have parabolic capital inflows into money market funds in the US. Do you think that that's a red flag that some of these European banks are starting to have very serious stress?
Yeah, I do. They're tapping massively kind of dollar funding lines. A lot of these foreign money market funds, because, like I said, a lot, with the Eurodollar system, a lot of people do not have a continued access to dollars because they can't print them. And so, as a function of that, they essentially go to money market funds to try to get, dollar funding access. And if that starts to dry up in money market funds, whether you're just seeing outflows or decline in kind of overall volumes, or money market funds kind of stepping away from being marginal buyers of commercial paper from banks, then that starts to put a lot of stress on the European banking sector, and you start to see them massively come into the market looking for funding sources for dollars to kind of backstop that hole.
Do you think these European banks have a lot of losses throughout their loan book, or are they losses on older US treasuries? Where do you think the losses are coming from?
Yeah, well, the losses are massive, and the ECB's financial report was essentially saying that they were coming into the end of the year. I believe it was about $5 billion of loan loss provisions in euros. Sorry, 5 billion euros in loan loss provisions that they actually had to utilize just to break even on the losses that they had on their U.S. holdings, especially fixed income. And they were setting aside, I believe, another 30 billion euros going into the future to kind of hedge the anticipation of further deterioration, obviously in bonds, and maybe for people who might not know, yields and the price of bonds are inversely correlated. So obviously, as yields go up, the price of the bond goes down, and vice versa. As yields go down, the price of the bond goes up. So, with where yields are and relative to where these banks were holding, I think you were seeing like average yields at around 150 or 200 basis points. They've had to set aside massive provisioning, and that's the central bank. And so I think that problem is more drastically exacerbated when you're starting to look at actual commercial banks that don't obviously have the ability to just, quote, print money, unquote. And I use that very loosely. But yeah, I think for the commercial banks, this is going to be a much bigger problem.
And they have losses throughout their loan book. So on commercial real estate, I'm sure that there's serious commercial real estate problems in the European Union and England as well, not just here in the United States, although it's in every major city and metro area. So I'm sure that's similar issues in Europe as well. But they also, what did with the European Central Bank negative interest rate policy, there was a ton of extra European corporate debt that was created with negative interest rate policy. A lot of corporations and private businesses issued a lot of extra debt at artificially cheap rates, and that debt was not paid off over the last 7 to 10 years. And they had negative interest rate policy for a while. So that debt now is being repriced. It's being repriced or rolled over at much, much higher rates. So it makes sense that the European banks have a lot of problems throughout their loan book, as well as losses on older US Treasury bonds, especially if the dollar continues to rally.
Yeah, I would agree 100%. I mean, even if you were to just look at something, this is a more extreme example, but if you were to look at something like, Austria issued a 100-year bond, I think in 2020, like the second half of 2020, that's down 75%. Right. So, I mean,
well, it's bad for the holders, the people who bought the bond as an asset. Maybe it's good for the government because their debt's being inflated away.
Inflated away, yeah, but there's definitely been big problems, especially for Europe, because you, like, as you mentioned, you're coming from negative interest rates, even at 300, even at 400 basis points. That's a lot of stress, right? So
plus they have worse inflation. Their inflation rates are higher, right, relative to the US, the official inflation rates anyway.
Exactly. And, I, especially with how weak the euro's been, I think that also puts Europe at a very vulnerable state, because it's like, if you're Lagarde, do you continue hiking and risk, massively slowing the economy, or do you stop hiking at the kind of the demise of the euro, which has already been relatively weak over the past, like, let's say, year and a half? I think that puts them in a much larger predicament than somebody like the Federal Reserve.
Well, also, I think the problem is the textbook. So the textbooks for these central bankers say to fight inflation, they need to destroy demand and raise interest rates. But the problem is the narrative out there is that higher interest rates are good for the banks. But if the banks issued a lot of loans at lower interest rates, the higher interest rates now, if the debt's going to be rolled over at a higher interest rates, but don't the banks also have a lot of losses when the yield curve starts to go upward sloping and the interest rates are higher? Don't the banks also have losses on their loans that were issued at lower rates?
Yeah, yes, they do. And I mean, this has been a big problem for a lot of banks. And so, I mean, I don't think that the banking sector is entirely out of the hole. So, I think that a lot of people have kind of set it behind. But, one bank, I mean, a lot of people have been screaming about this, but the Credit Suisse debacle, I was actually covering very closely on Twitter, and I was like, they're not going to make it. And everybody's like, no, everybody's been saying that for a decade, Credit Suisse. And sure, I mean, I could have just gotten lucky. I mean, a lot of calls are somewhat luck, right? But I was saying that this time is massively different. There's something called like the FRA OIS spread, which, just think of it as, in very simplistic terms, a kind of a measure of bank stress. That was massive. They have bonds in Europe that are set up in the banking sector called contingent convertible bonds. And essentially, because of the way that they function, they tend to be more sensitive to credit stress. So they tend to actually be a leading indicator to things like, credit default swaps. And I was like, where we're seeing things now, they're not like, I don't believe that they're going to make it. You were seeing massive strain in funding markets. You saw the Swiss National Bank, I think, tap some of the highest amounts of liquidity swap lines from the Federal Reserve. Maybe in history, I'd have to go back. I have that chart somewhere on my page, but it was huge. Majority of that going to backstopping Credit Suisse. And so, now things have kind of subsided. And I think, there's kind of too much quietness on the northern front, so to speak. So, I mean, I could see there being, further stress that's just kind of, the market has become very complacent in Europe. And so, I mean, that's something that I continue to monitor.
Well, I was actually told by hedge fund manager contacts over 12 months before Credit Suisse failed that the Archegos story was way bigger than the mainstream financial media was saying. So I think like they only took about 5 billion in losses, I think, from Archegos, which was all their annual profits for one of those years. But the actual size of the loans for Archegos, I think, were around 30 billion. And the hedge fund managers that were researching this were telling me, look, they gave out other loans similar in size to other hedge funds, to other family offices. And then on top of that, didn't Credit Suisse, they had like a lot of loans out to private equity. So as the Fed was raising interest rates, private equity and their other loan book, their commercial real estate loan book, those European loans that you said are being repriced at higher debt, and now those are zombie companies or bankruptcies. Credit Suisse is just getting like their whole loan book, and a lot of their loans outstanding were either going into default, they weren't getting the cash flow, or their loan book was just blowing up.
Yeah. Yeah, exactly. The Europeans have had a very tough break thus far. And the other banking sector, which is actually north of the border, that I continue to watch is obviously Canada. And, I think that a lot of people kind of discount Canada. Obviously, it's a relatively small economy on the global scale, like when you're comparing it to things like Japan, things like, a lot of the more industrialized European countries, obviously the United States. I think that a lot of people kind of discount it, but, Canada also has this, I would say, brewing problem. I work in Canada, even though I'm an American. I grew up most of my life in South Carolina. what a lot of people don't realize about Canada is the way that their mortgages are structured. And so, for us in the States, we can take a 30-year mortgage, right? And you get that rate for 30 years, unless obviously you refinance. But in Canada, you can only take a 5-year fix. So after 5 years, you're up for renewal. Or you take a variable rate. And essentially now with variable rates in Canada, all of them are essentially in negative amortization. And so this is a massive problem for Canadian banks. Half of the variable rate mortgages with fixed payments, which is about 15% of all mortgages, reached a trigger rate. And so what this essentially means is at this point, the monthly payment covers only the interest payment and essentially no principal, right? So people are only paying interest and they're not actually paying down their mortgage. So this is extending amortizations. Like there's been, I think, stories of people having like 80-year amortizations now. The problem then becomes OSFI, which is the regulator in Canada, has actually come out and said, we might need to start proposing higher capital charges for these banks with negative amortizations. So anything over a 65% loan to value will no longer meet underwriting standards. And that will require somewhere between 15 to 25 percentage points increase to risk weights. This is bad for Canadian banks because as risk weights rise, capital ratios compress. And in Canada, risk weights have been extremely low because it's all model driven. It's slightly different than what we have in the US with CECL. But, what right now the expectations are is for compression of around 50 basis points. And some people say, well, that's not a lot, but let's say, capital ratios compress by 50 basis points. That probably means that usually what it would mean is it's like risk weights start to increase. So like if risk weights, for example, go up by 100 basis points, capital ratios usually compress by about double, so like 200 basis points. So this whole variable rate mortgage situation, the renewals also plays a big part in possible compression from Canadian banks. And so I do think that that's also a possible mounting catalyst for the Canadian banks, unless somehow they're backstopped. And I'll end it here. That the important thing as well to note is Canada has a different mortgage structure than the United States. So we have Fannie and Freddie. You can essentially sell those mortgages off your books. You no longer have to hold them. In Canada, the banks are incentivized to hold the mortgage by CMHC, which is essentially a crown corporation. So it's not owned in, it's somewhat, let's say, separate from the government. And so essentially all of these banks are holding all of these mortgages on their balance sheets. And
they haven't dumped them at a place like a bad bank or a place like Fannie and Freddie yet. That's a government sponsored enterprise that was basically used for a bailout facility.
Exactly, because in Canada they haven't really had that. One, you don't have a big mortgage market, and I'm not 100% sure on the specifics of like the qualifications that have to be met for the MBS market in Canada, but I think it's like they have to have like a loan to value of like 85 to 90% to actually go into like an MBS. So like the MBS market here is like very, very, very tiny. It's not like the United States. So like these banks are holding, essentially $2.5 trillion, which is, larger than the Canadian GDP on their books and mortgage debt that's outstanding. So it's huge.
And now let's try to simplify this a little bit for our listeners out there, because you use a lot of complicated banking terms. So you work at a bank, and if you were speaking to another banker, it would make a bunch of sense. So let's try to make it simple here. So if home prices fall, then that means then that the mortgage value that the Canadian has to pay off with the 5-year mortgage, the mortgage value is more than the home price. So if home prices, I think I heard in Toronto that home prices have fallen on average about 30% over the last couple of years. So if home prices are down more than 30%, does that mean that a lot of home prices in the major cities in Vancouver, Canada, are they no equity, or are a lot of people underwater in their mortgages?
Yeah, especially people that have bought kind of throughout the pandemic. A lot of those people are underwater. A lot of investors are underwater. Um, and so that becomes the problem. And so to simplify it, when you take a mortgage, the underlying collateral of that mortgage is marked to market because it's a house, right? So as you mentioned, if house prices come down, then all of these banks are essentially sitting underwater on these mortgages that are on their balance sheets. The problem then is amplified by, okay, you can kind of mitigate that, but what happens if you get an economic slowdown? Let's not even say anything crazy, but where you see a increase in unemployment, and now you start to have mounting delinquencies. Um, and so the easiest way to explain this is if you look at the mortgage books in Canada, just the mortgage books, they're only assuming 25 basis, even to this point, they're essentially assuming 25 basis points of losses on their mortgage book. Okay. So if they, see, which is not anything bad, but if they were to see, mortgage rates at, let's say, or let's say they start to see delinquencies at 100 basis points, which is like a normal credit cycle, that's like 4x their current capitalization ratios. Right.
Now, are
So
these so the losses, the banks would have like their balance sheets would be blown out. They'd have like negative equity. The banks wouldn't have negative equity. They'd be stuck with these home prices. Would there be strategic defaults? Are the banks going to get stuck with this stuff then? Because if in the United States, and the rules I think were changed, but like during the last housing cycle, 2008, there was a lot of people who were underwater in the mortgages, and they just said, I'm going to take the hit on my credit score. I'm going to hand the bank back the keys to the house. And the banks got stuck with a lot of this stuff for a number of years before the federal government and the Fed gave BlackRock and hedge funds and private equity and some of these pension funds like artificially cheap debt to go buy these homes.
yeah,
Are the Canadian banks going to get stuck similar to the U.S. banks with like strategic defaults?
I think that they could. The problem in Canada, though, is because it's such a large percentage of GDP. Like if you take construction and then the financial and real estate industry, and you take like residential construction, sorry, let me be specific. Residential construction and the fire and like the financial and real estate sector, it's about 25% of GDP. So you obviously cannot let that contract massively. And so I think what they would essentially do is bail-ins. And you know, I've read, like I've done my own modeling that if you were to see like, even like defaults on mortgage books at like 250, 300 basis points, like the Bank of Canada would need to step in with roughly, between 75 and $100 billion worth of quantitative easing to backstop the banks, which given the size of Canada is massive. That's like what the Fed was running like in the very beginning of the pandemic. Right. So just to like quantify that, because you have the Canadian GDP is what, like 2.5 trillion, and you have essentially that amount of mortgage debt. It might be more now. It might be like 2.9 trillion in mortgage debt outstanding. It is larger than GDP. I think mortgage debt as a percentage of GDP is like 105 or 112%.
No wonder the hedge fund manager, that was one of them that was featured in The Big Short, the book by Michael Lewis, and the movie, what was it, Steve Leisman or one of those other
Steve
guys, he
Eisman.
starred.
Yeah. Steve Eisman. Yeah.
Yeah, sorry, I said it wrong. I said the bald guy on CNBC that the Fed leaks information to. Steve Eisman, Steve Leisman, sorry about that. I think Steve Carell played him in the movie. Anyways, though, I remember, was it 2019 or 2020? I think he was a little early. He started short positions in these Canadian banks, and like the mainstream media, the Canadian financial media, BNN, Bloomberg, or I think Bloomberg bought BNN, and they were just calling him names. How dare you? How dare you short our banks? And it's like our banks are way better and safer than U.S. banks, but are Canadian banks really safer? Or do they use less fractional reserve banking than U.S. banks?
They actually don't have any reserve requirements in Canada.
What does that mean for the listeners? Does that mean then that they can lever? They're not 10-to-1 fractional reserve banking, or that what are they doing that
No,
they have no?
I think average in Canada has been between like 12.5 is like the long-term historical average of the reserve ratio. But I think like as of recently, it's like 15.
So
So
what that
15 to 1.
so that means then what a 6% drop, give or take, in the value of their assets, and the bank is basically insolvent and needs to be bailed out.
Yes. Yeah, something about that. Yep.
That's crazy. That is not good. And from speaking with my business contacts in Vancouver, Toronto, on top of this, it sounds like not only home prices falling and the underwater on the mortgages, it also sounds like there's been a lot of Canadians that took advantage of those higher home prices. They took out home equity loans. They loaded up on credit card debt during the pandemic with stagflation and shrinkflation in Canada. So there's also a lot of consumer debt with credit cards and in the home equity loans. And that would spell trouble then if the economy goes into a worse recession or home prices continue to fall.
Yeah. Yeah. It will definitely um be exponential for the Canadians in terms of overall slowing.
So would you say then, and I know you work in a Canadian bank and you look at this data, would you say that this is the worst shape that Canadian banks have ever been in then?
I would say probably, yeah, in at least in the give me 1 second. I want to see I'll give you a actual breakdown. Because I like the last time I think that you've had a drawdown like this in Canadian banks year to date. Um, it's was probably, over the last year, they're down about 15%. And the last time that you probably saw something that drastic besides COVID, would have been, kind of prior to 2000. I mean, 2008's much worse, but I mean, this is probably like the
Are you
third.
talking share price down 15%
Yeah,
or?
yeah, share price. But if you were to kind of look at where they are now, this would probably be like, the third. And COVID was more, I wouldn't even consider COVID as much of a financial shock, because at that point you had, like this massive monetary and fiscal support. But now, I would say this is probably like one of the second worst years for Canadian banks, probably in the last, 20 years. So, I mean,
And
they're
for,
definitely going through a bit of a tough point here.
yeah, one of my business contacts in Vancouver, he was telling me that like the levels of credit card debt in Vancouver is absolutely insane, and property prices in the major cities and metro areas in Toronto and Vancouver, aren't they down like at least 20-25%? Some of them more than that.
Yeah, they were. They've started to rebound slightly, but the problem is, you're now starting to see things like increases in employment. You're seeing an increase in the layoff ratio. So you're seeing bankruptcies in the business, like aggregate bankruptcies in Canada for like, so this is aggregate businesses, all of them combined, large, medium, small sized companies. Those are up 30% year over year, again, off a very low base, but this is like some of the highest rates of bankruptcy that you've seen in the last 20 years. It's about double what you saw during 2008, because now you don't have the monetary tail or headwind, right? Like the monetary
Well,
support's gone, the fiscal support's gone. So
You'd also don't have a bull market in commodities and a strong Canadian dollar, right? So the Canadian dollar isn't rallying a lot against the US dollar. So I from speaking with people in Canada, it sounds like there's been a lot more inflation in Canada because they have to import a lot of food and other stuff because they have winter so much in many parts of Canada throughout the year. So they have to import a lot of items, especially food. They do have a good amount of energy up there, at least in parts of Canada, but they do have to import a lot of food. So those imports, the cost of those, and if their currency is getting weaker, those imports are going to be expensive, and that's going to be stagflationary or inflationary.
Yep, exactly. Exactly. It definitely will be. And so they're going to have a tough time, at least going forward here.
Do you think then that the Canadian government's going to go to the Federal Reserve Bank and say, hey, we need some US dollar currency swap lines to help with our banks? Or do you think they're going to maybe install something similar to Fannie and Freddie, kind of like a bad bank, a government sponsored bank or something like that, and just shove some of the mortgage debt or other stuff into there?
No, I'm pretty sure they will just end up doing a backstopping themselves. I think that that's what makes the most sense for them to do is just backstop all of this. So that's probably the route that Canada will go.
Yeah, I've had some Canada friends tell me they think bail-ins, but I mean, like, there has to be some type of maybe they do some bail-ins, but it's probably going to be some type of bailout too, because I mean, the banks, it sounds like the banks are in deep, deep trouble. It's not just real estate, it's the consumer debt, the rest of the loan books on top of that too. So it's like if real estate prices continue to go down, people are underwater in their mortgages, they default. It's a vicious cycle similar to the US, but then the rest of the loan book for the banks are also in trouble.
Trouble, yeah, exactly. So it just becomes a vicious cycle.
So I know we were discussing this before we started recording. Do you also see similar problems with banks, say in Australia, emerging markets, other countries as well?
Yeah, Australia, I haven't looked at as deeply, I'll be quite honest, but looking at places like China, I definitely think that they're going to start to have a bit of a problem. Um, like, because, China has been very interesting. One, um, we've seen a lot of, you know, attempts to kind of have policy support, but that hasn't really materialized. Obviously, we've seen a massively um, depreciating yuan. You've seen, the Chinese try to they're actually both selling treasuries on a net basis as well as buying yuan in the forward market, which is another way to try to stabilize the currency. Um, and at the same time, you're having a lot of these banks, have this kind of massive appetite for safe assets, and that's definitely nothing that's denominated in Chinese yuan. So yeah, I do think that if anybody starts to have more problems, it will probably be the Chinese. And the second problem of that I believe is going to continue to be a mounting risk again is going back to real estate, right? Like, China has been trying to stimulate, right, by keeping rates low, hoping that this will spur demand. And thus far, we're really not seeing anything like that happen. And so,
Are you
kind
talking
of,
about buying more house by stimulate demand? Do you mean people going out and buying more houses or consume? What are you talking about by
yeah,
stimulate?
yeah, buying more houses, going in and, speculating in the real estate market, which was a kind of a big, um, driver of investment. All of that has just there is absolutely no demand for that anymore, at least from investors or even consumers. And I'll actually get you just a kind of to paint the picture. I have like a data point here. Give me just 1 second. But yeah, for the Chinese, I definitely think that this is going to continue to be a big, big issue is going to be the fact that they're not able to stimulate demand, despite where monetary policy is. And so, I mean, I think that that's classic, um, kind of the classic definition of a liquidity trap.
Well, there's also conflicting policies in China. So you have Xi Jinping, who has said he wants cheaper real estate prices for young adult males and young couples to go buy homes that can afford homes. The problem is the entire Chinese, their regular banking system and their shadow banking system, the collateral in the system is all based on higher home prices. So if home prices are falling, it seems to me that their banks then are going to have a lot of problems, especially in addition to that with falling home prices. And a lot of people aren't aware of this. There's many trillions of dollar denominated debt inside China. I mean, I hear people all the time that are not aware of this. I mean, there's a ton of trolls on Twitter that are in the Bitcoin community and gold community that are like, oh, China's going to collapse the dollar. They're not aware that there's trillions of dollars in dollar denominated debt that was created by Chinese banks and Japanese banks inside the Chinese economy.
Yeah. So this was the data point that I was looking for. So, looking right now, you have very weak sells and developer defaults, which I think will probably continue into next year. So, like if you look at things like leading indicators, which are like starts and land purchases, sorry, in China, those are still in deep contraction, negative 20% year over year, year to date. So, if you're looking at even months of inventory, which is how much, housing inventory that's been built, is essentially on the market. As of 3 months ago, it was about 18 months. Now you're coming up on 30 months. So it's almost doubled, in a relatively short span, in a span of like 5 months, you're seeing just months of inventory rise because nobody's out speculating in housing. There's no investor demand to actually go and buy housing. So I think for a lot of these Chinese companies, and banks especially, this is going to start to, mount massively for risk for a lot of these banks.
Well, also a lot of these real estate developers, whether it was Evergrande or Country Garden, some of the largest Chinese real estate developers, they took out a lot of dollar denominated debt to speculate and build the homes on. So if home prices are falling, there's not the demand, like you said, to buy those new homes. There's tons of inventory. So that's loss of supply, less demand. And then they have all this dollar denominated debt to service, plus their currency is getting weak. It just sounds like a disaster for Chinese real estate developers. And then on top of this, for the banks that are their counterparties.
And, I agree with you. And I also think that something that you were touching on before, which is kind of this the selling of U.S. debt. It almost creates like this feedback loop, right? Because you're trying to strengthen your currency, but then you're selling dollar collateral, which China desperately needs, which then worsens the shortage of collateral within the financial market because now there's less dollars. And so it just it's like a snowball effect, right? And so not only is their currency weakening, but now they're having like collateral problems where there's just so much collateral shortages. And, within the shadow bank system where people are looking to actually go and, they're looking at China saying, okay, we'll give you collateral, but we're going to charge you this massive premium because there's a huge amount of default risk there, right? So,
the collateral may have changed. I mean, the collateral in the past for the shadow banking system, it was similar to a pawn shop. I read this in the book by Denny McMahon called China's Great Wall of Debt. It's available on Audible audiobook. I've interviewed the author too. And so he interviewed like factory owners many years ago when the factories weren't profitable anymore, and they pledged all their factories, their residential real estate, their office buildings, all the other their condo towers, all that stuff was pledged as collateral for additional loans in the shadow banking system. So a lot of the collateral was real estate, but now prices are falling.
Yeah, exactly. And this is a massive risk that is mounting for the Chinese. So I definitely think that that's something to keep an eye on, like going into the beginning of this year. I mean, we're all, or 2024, because we're almost out of this year here. We got about a month left, or a month and a half left
before
January. So yeah, I mean, it's definitely.
Oh, do you think then that this means weaker currency for the Chinese yuan against the dollar, that they're going to have to do more bailouts? It's like a vicious cycle, it seems, for them too, because their real estate developers are going to have more problems. There's too much supply. There's not the demand to go and buy houses that there was for the last 15 or 20 years in China. The developers then are in trouble because of their dollar denominated debt, and their currency is probably going to get weaker. And it sounds like they're going to have to do a lot of bailouts inside China.
Yeah, I think that they will, because I don't think that this is going to be another Evergrande moment where the government can kind of just like throw it to the side. I think that this is going to be too big of a problem. So no, I definitely think that that is going to be a huge risk for the Chinese as well, is how do you mitigate this, right? Because, Xi Jinping and the government is just not going to be able to sit back, I believe, this time and just let this happen. I do believe that they will be forced to kind of step in and, backstop the system, because if not, there's going to be no kind of faith in the Chinese government any longer, and I think that that's a big point of contention for them as well.
Well, that's why Bitcoin prices and the gold prices in mainland China are so strong, with the premiums and the demand for Shanghai gold from the Shanghai Gold Exchange. Private sector Chinese demand is very strong the last 12, 18 months. And then the People's Bank of China has been large net purchasers of gold tonnage the last 12 months. Seems like a lot of people in the private sector in China are hedging with Bitcoin and gold because of falling real estate prices. But I do want to talk about this. It does seem like conflicting policies, because Xi Jinping, I've interviewed Kyle Bass in the past. He said the Chinese government, the Chinese Communist Party, the leaders at the top, they want lower home prices, but then basically that would implode, that would nuke their banking system and the collateral. So if the political leadership at the top says we want lower home prices for young adults to buy homes, but their entire banking system and collateral is based on high home prices, seems like the banks are in deep trouble unless they get bailouts then.
Yeah, they will be. They'll have a huge problem unless they get bailouts. But I mean, it almost seems like one of those things now that's just so likely that the Chinese are going to have to do is they are actually going to have to step in and start offering bailouts to these people. But I mean, it's like one of those things where it's like, I guess, we will see what ends up happening. But I do think that that is going to end up being kind of a big factor in the normalization of kind of normalizing the Chinese situation, at least from a monetary and fiscal standpoint.
So would you say then the Fed raising interest rates has really hurt a lot of banks outside the US more than US banks? Because isn't it banking 101 that an upward sloping yield curve was good for banks in the past? But it seems that what the Fed has done with raising interest rates that quickly has actually hurt a lot of banks with the pace of the rate hikes, that like there was all this debt outstanding post 2008. There was a ton of, I think we went from 200 trillion of total global debt in 2008 up to 300 trillion. And now it's going to have to be rolled over at much higher rates. So you would say then that would you say that the old banking laws of the past of like an upward sloping yield curve, those are no longer true now with the total size of the debt now, that the upward sloping yield curve is not good for banks?
Yeah, I mean, I think that now the upward sloping yield curve is probably not good for banks. I would say that this whole cycle has taught us that a lot of things that have been true in the past are essentially no longer true. And I think that that's something that, anybody who kind of manages money or watches these things very intuitively needs to start to realize. Because I don't think that we can any longer continue to kind of extrapolate, previous models to work going forward. Because, thus far, I believe so much has changed. And so I just think that that's something that we have to realize, and something that we have to monitor, right? Because if you're starting to look at a lot of these things that are going on within the yield curve dynamic. I mean, in theory, you would think like, and I guess, I mean, we could say earlier in the year this happened with people like SVB and First Republic, but the overall problem is that in theory banks lend borrow short and they lend long. So in theory, like an inverted yield curve should be a massive problem for the banks. But thus far, I mean, with the exception of people like SVB or like First Republic, it seems like again, somewhat the banking sector is doing okay, despite thinking that this inversion would be doing a lot of pain. For the banking sector, thus far, we really haven't seen that. And even if you look at SVB, it wasn't as much of a problem about the yield curve as it was like, when they were modeling, they were assuming, I think, on like the upper end, like 75 basis points that they'd have to pay out in deposits. And obviously, with where yields went, with where, money market funds rates went, they just saw massive outflows and a massive call on deposits because they just couldn't pay, for 5% on deposits. And so, you just had this massive rush out of banks into money market funds. And those people who were not capitalized to handle that, were really suffered. But besides that, like the inverted yield curve hasn't really done, I think, as much harm as many people would have been anticipating on banks.
From speaking with hedge fund managers, to your point, it sounds like there's accounting gimmickry that a lot of these banks are not taking actual mark-to-market losses yet on their older U.S. Treasury bonds. So like Silicon Valley Bank did, but a lot of these banks realize that there's not a bunch of equity capital available from institutional investors, pension funds right now to re-liquefy the balance sheet of the bank. So a lot of these banks are intentionally hiding. They're legally allowed to do this. They don't have to mark to market all their losses, but they're going out of their way to not mark to market all their bond losses and the rest of their loan books yet.
Loan books yet. Yeah, obviously, which I mean, I think that they're trying to do to just mitigate their own risk. But yeah, I mean, there's been a lot of interesting things that have happened in the banking sector. And I do think that it's probably a sector that people should not start to discount quite yet, because I do feel like there's been a lot of kind of, people wanting to write off like bank stress as, something that's probably in the rearview mirror. But I do think that could probably start to rear its head a whole lot faster than many people are anticipating. And so, I mean, I just think that that's something that people really need to be cognizant of, especially, like I said in the very beginning of this, if you start to see massive stress within money market funds, I do think that would really start to be the catalyst of, massive slowing within the banking sector.
I agree with you that the problems with the banking system are far from done. I mean, if the banking system problems were over, why is Jamie Dimon, for the first time in his professional career as the CEO of a bank or senior management at a banker, why is he selling what $150 million approximately of his shares?
Yeah. Yeah. I mean, there's like those aspects. Those are things that people need to watch. And I mean, even, Jamie Dimon himself has come out and he said different things about the banking sector. Like he doesn't think, and obviously I'm not like a complete bear, but, there has been things that he himself has said that are, extremely kind of, telling of where he believes that the banking sector is going to be in the next couple of months. And I think that if you actually look at, what JP Morgan themselves have been doing, like obviously they've been for a significant amount of time now, they've been essentially fortifying their balance sheet. And so, I mean, I think that that's also very telling that they don't believe like kind of the worst or the worst of the risk is behind us.
Well, the banks are also tightening credit, but from what I'm hearing, I mean, and I speak with other bankers too, besides just you, American bankers at other large banks, Chicago, New York, elsewhere, it just sounds like extend and pretend game similar to 2005, 2006, 2007, except this time the major problem is commercial real estate and it is office buildings. And it sounds like the problem is in every major city and metro area. It's just shocking from some of the stuff I heard, what the banks are doing behind the scenes. They're trying to get almost anyone to buy these office buildings so the banks don't get stuck with these things in strategic defaults. Also sounds like behind the scenes, from what I was told over the summer, you had the FDIC and other banking and regulatory agencies. They're already changing the laws to prepare for bailouts in the near future. The Federal Reserve Bank was calling around regional banks, asking for more exact information for commercial real estate loan books. On top of this, even the lawyers on both sides of like a commercial real estate loan, the mortgage, the lawyers on both sides, and they don't want to lose their jobs. They're high paid employees. So if commercial real estate has a bust, they'd probably get fired. So they're probably ordered by the bank. They're changing the legal definition of default. That was done over the summer. There was a Reuters article on this. So this is crazy. They're doing all this stuff behind the scenes. And this is why there's not like wide scale problems with all these banks yet in default, similar to like 2008, but this time office buildings and commercial yet.
Commercial yet? No, I would definitely agree with that.
But do you think, though, that the commercial problems, it's not just the United States, you'd say then it's also similar in what European Union, England, Canada, it's very similar to in a lot of other countries?
Yeah, I definitely think that this is a problem that is going to end up facing a lot of other countries. And I don't think, it's just going to end up being confined. Is going to be confined to the United States. I think Europe's probably in a much worse position. I think China's definitely in a much worse position. So yeah, I mean, I do think that this is going to end up being a much larger scale problem than a lot of people are attributing weight to.
And China also has the residential home prices falling. So it sounds like they have a commercial real estate problem too. That's just crazy.
Yeah, exactly.
Well, as we wrap up here, I want to get your thoughts, since you did mention warning signals for money market funds. We're starting to see just parabolic numbers for what hedge funds, retail investors, the last couple of months going into money market funds. Do you think then that this, besides the European banks going in there, you think that this is a red flag that if too many of these entities think that it's quote unquote risk-free to get around 5% of money markets, you think then that it's a red flag if more capital continues to go into these money market funds?
Yeah, I do think that it could start to create some stress. And this is obviously something that you start to see. I do think that this will be, alleviated as the yield curve starts to normalize. If we go out of inversion back to a normal upward sloping yield curve, I do believe that that money market funds will start to see outflow, or we'll start to see outflows if we start to have a normal upward sloping yield curve. And those things usually tend to follow each other. So if you're looking at like the 2-10 yield curve, and then you look at asset under management for money market funds, those things tend to correlate. So as you see and they're inversely correlated. So as the yield curve starts to invert, the increase in money market fund assets starts to increase. And that's just due to the fact that people want, something that's relatively risk-free, something that's relatively safe. And the way that they do that is by going into money market funds. But I do think that, if the longer end of the curve continues to rise into the end of the year, and you start to have, normalization, through the yield curve, that you will start to see, money market fund outflows start. And that's where, like I mentioned in the beginning of this, that you really start to see dollar shortages, because those money market funds then step back from being kind of the, marginal buyer of commercial paper, stop kind of being there to help, provide funding sources to the commercial banks. And that's where you get into a bit of a problem, where you start to see things like cross-currency basis swaps widen, because people are going, there's a premium, there's anticipated risk. And so because of that, it starts to become more expensive to access wholesale dollar funding.
Okay, so to summarize that in easier to understand terms, you're saying that these foreign banks, so European banks, Canadian banks, emerging markets, Chinese banks, they use money market funds for access to US dollars then?
Yeah, those money market funds are a big supplier of US dollars. Yep. So that's why if we start to see the yield curve normalize, and you start to see an outflow from money market funds, that's where you could start to get, stress within the banking sector, just because they're going to end up having a massive problem accessing liquidity, because money market funds are going to be busy trying to mitigate the outflows that they're experiencing. So they're going to step back from buying commercial paper from banks.
Now, you said you expect the yield curve to normalize and maybe the 30-year U.S. Treasury, the yield to rise in an upward sloping yield curve. But if that happens, won't that make funding U.S. federal government rolling over this massively growing U.S. national debt? And we're running over 1.5 trillion per year budget deficits. I've seen estimates for the next 12 months at up to 2 trillion per year budget deficits. So somewhere in that range of 1.5 trillion to 2 trillion. Won't that make it very difficult for the U.S. federal government to get funding at lower interest rates? Won't there be do you think that there's enough foreign demand then for these U.S. treasuries?
Well, I mean, we're seeing that now. Like, China's been a net seller, but if you look at like the TIX data, which is the treasury data that they put out, you've had like this V-shaped recovery, and it's actually like a V-shaped recovery. So in other nations starting to buy treasuries. So there is definitely demand there for treasuries. Obviously, the longer end of the curve is not going to be what's attractive, but also the US government's not issuing on the longer end of the curve, right? The US government's issuing on the shorter end of the curve, and that's what we've seen with like most of the issuance being bills and notes. And so, I do think that is very kind of very kind of normal, because they're not going to want to start to issue a massive dearth of supply at 30 years. They'd rather be issuing more short duration. And so if the long end starts to rise or even if, the front end starts to come down relative to the long end of the yield curve and the belly of the yield curve, then you'll start to get that more normalization, which I do think is going to start to happen as, like we talked about in the very beginning of this, where the market's kind of anticipating cuts. So I do think that you'll probably, unless you get some sort of like crazy economic data point, like GDP comes out at like 2.5%, and people are like, okay, higher for longer, cuts then get pushed out again, then obviously, you'd probably stay inverted for a while. But absent that, if the yield curve or the shorter end of the yield curve continues in the way that it's continuing, I do think that you could come out of inversion much quicker than a lot of people are anticipating.
This is very counterintuitive, because it seems that U.S. Treasury Janet Yellen, what she should be doing is she should have been issuing a lot of 30-year U.S. Treasury debt and locking in lower rates in the past, terming out the debt, similar to what an emerging market would, what Argentina or some of these other countries that were selling 100-year bonds and then inflating the debt away. So the holder who bought the bonds gets screwed, but the government that issued them gets to inflate away the debt. But it seems that the policy, Yellen, she just wants to issue everything at short term, roll it over really quick. The problem now is what a lot of that debt that's coming, that needs to be rolled over soon. That debt was issued right around 2% a few years ago. Now it's going to have to be reissued at 4 or 5%.
Yep, exactly. That's going to end up being the big problem for the
U.S. federal government finances, for interest payments on the debt, and that's going to start to take up larger and larger chunks of the annual tax receipts. I mean, I think we're almost at 30%. Oh no, not yet. I think by end of 2024, we're looking at, if it gets to 1.3 trillion per year for interest payments on the debt, we're looking at around 30% of the annual tax receipts.
Yeah, something about that. Yeah.
Yeah, the math is starting to not work.
No, I would agree with you. Yeah, I do think that that's something that the government's going to have to look at. But at the same time, the larger the deficit grows, the more that we can kind of supply the world with dollars, right? So it's almost like kind of a feedback loop, right?
Well, wasn't the euro dollar supplying the market with dollars and without the Federal Reserve Bank issuing treasuries, though?
Yeah, I mean, the euro dollar market definitely does, but obviously another big way that happens is through the deficit, right? And I mean, that's kind of what Triffin's whole point was with the Triffin dilemma, is that when you're a reserve currency, like just forgetting the euro dollar market for a second, one way that the government ends up, you know, exporting its currency is by essentially running a deficit and having everybody else run a massive surplus.
Well, the system is starting to get ridiculous now with the total size of the debt. I mean, the math just doesn't work in lots of places. If home prices fall, there's just not the cash flows to support the debt. So, I mean, historically, governments, especially the world reserve currency, they don't do a normal default, so normal haircut on stuff. It's normally what 1940s or 1970s, and they
Mhm.
do what stagflate tax lie or yield curve control, and they focus on inflating the debt away in real terms. So, do you anticipate that that's kind of the end game?
Yeah, I mean, I do think that that's something that they want to do, right? Is to inflate the debt away. But also, I mean, like, I think that this is also, Dr. Lacey Hunt's whole point is like, you know, for what it's worth, debt is deflationary, right? And so, I mean, it starts to make this binding constraint where essentially you have to continuously pull future or current and future cash flows forward for the repayment of the debt because what debt is being utilized for is no longer productive. So I think that that's probably something that's going to continue to happen as well.
Wait, is he saying that all debt is deflationary or private sector debt is deflationary? Because I mean, we have to make a distinction here. Because like governments normally, they would prefer to inflate the debt away and then use the cash for other stuff, or the politicians are stealing. So I know you're from an emerging market country, but historically, like governments don't normally honestly default on a lot of debt, saying like we can't pay back, we're going to do a haircut right now. I mean, normally governments use inflation. So is he saying that private sector debt is deflationary?
Yeah, private sector debt's deflationary, but I I also think depending on like what you do, like for example, government debt on interest payments is somewhat like a stimulus for aggregate demand. And even if you start to look at fiscal outlays, which are essentially like net private sector injections of cash flow, right? The fiscal outlays. So those are things like transfer payments, debt payments on debt, debt payments on debt, um, or interest payments on debt, sorry, subsidies, etc. Like all of these things are somewhat like a stimulus to aggregate demand as well. So, I mean, that's also something to watch going forward because that therefore as well can kind of be a further constraint on lower rates of inflation because if people are getting this massive boost continue from the fiscal side even though the monetary side's tightening, you're still going to have this push pull at least in terms of inflation.
I mean, Dr. Lacey Hunt, I think he was saying that there was going to be no inflation in 2020 and 2021. So the guy's a really smart guy. His PhD. He worked at the Federal Reserve Bank, though. He's a bond fund manager. I mean, his bias is bonds, and deflation. So he didn't get the inflation prediction right when 2020 and 2021.
One, yeah. Yeah, I mean it's been a hard call. I mean, even for me, I think in the long run, at least for somebody like the United States, I would say that I'm more in like the disinflationary camp than I am the United States is not Turkey, the United States is not Argentina. So, I do think that from that aspect, we're probably in a more disinflationary environment than we are like in an inflationary environment. And that's just a function of the fact of how our um how our economy is structured, right? So
Well, I would say with cost of capital higher, wages going up in some industries, higher energy costs, there's a lack of investment on the supply side for commodities. I mean, I see a lot of stagflation. There was really bad stagflation 18 months ago. According to John Williams, the Shadow Stats, it got up to almost 18%, which is double the CPI. I would say it's substantially lower than it is back. It's substantially lower now than it was in mid 2022, so a little over 12 months ago. But it's still, I think, like the number one issue for polling for Americans is still inflation. So I would say inflation is, I see people on Fox Business now saying the Fed is beating inflation here on Main Street, small business owners, the surveys for input costs. It's not saying what the government economic data is saying.
yeah, Yeah, I would agree with.
Well, I'm in the stagflation camp, so I'm not in the hyperinflation camp because I think for a world reserve currency, I think it's very difficult for a hyperinflation. But we may see something like that in emerging markets, especially ones that have a lot of dollar denominated debt. So we could see some issues unless the Fed decides they want to start giving out currency swap lines.
Yeah, yeah, exactly. And that should be interesting to see if that ends up happening as well.
But if some of those governments fail, I mean, they may not produce the commodities, and then there will be supply side issues there too. It's honestly, it's just a mess of distortions with government and central bank policies at this point.
Yeah, which
Well,
makes it very hard to sniff out market signals, right? So
well, this is what happened during the 1970s too. The stagflation occurred in waves. So there was like bad inflation, and then Arthur Burns raised interest rates, and he thought he had inflation beat, so cooled off for a while, and then stagflation came back, and then Paul Volcker had to raise interest rates a lot. I don't think there's at this point raising interest rates at those levels would collapse the entire economy, and the government wouldn't be able to afford the interest payments on the debt.
yeah, exactly.
Well, I really enjoyed our discussion today. Thank you for explaining all that stuff in the banking system. It really sounds like the foreign banks, so Canadian banks, Chinese banks, European banks, emerging market banks. You don't cover Australian banks, but I've heard stuff about their housing bubble too, credit card debt problems there with inflation. I think the gold price in Australian dollar, the gold price actually, like in every currency except for the US dollar, Australian dollar, Japanese yen, Chinese yuan, the gold price is going crazy already. It's at or near all-time highs. So I really think that there's a lot of problems in a lot of these banks outside the United States. We have some problems here with a lot of the regional banks, but the major problems may occur in other banks outside the US first.
Yeah, exactly.
Great.
Exactly.
Hmm?
No, I was just saying I agree.
Yeah, especially if the dollar rallies. So, I mean, if we have like dollar index, I don't even think it takes dollar index 120. I mean, we have dollar index 110, 112, 114. It's going to be a margin call on those banks, on those foreign private companies, those foreign private banks, their dollar denominated debt that they've either loaned outstanding, that the companies, their counterparties don't service, or that the banks themselves borrowed.
Borrowed, yeah, exactly. It's going to end up being a big issue. But I just think that it's one of those things that people are going to have to be patient and just wait for. And obviously, again, like anyone, I reserve the right to be wrong. But thus far, this is kind of where
Well,
um,
I think we're seeing that. I think people waiting it out. I think that's what we're seeing with capital flows. So we're seeing people go to Bitcoin, people go to gold. They're not going to gold stocks, they're going to gold. The gold price is high in almost every currency. The US dollar gold price is okay. The the gold price in every other currency is high. Bitcoin price is high. And then people are going very liquid into what money market funds and short-term treasuries. So those seem to be the major inflows of capital right now.
yeah, yeah, exactly.
So if my listeners want to follow you on Twitter or take a look at your Substack, how do they do so?
Yeah, it's just at deer, like the animal, point macro, all one word, and that would be it for both Substack and Twitter.
Excellent. Well, we'll have you back on again in the near future. Thank you for Thank you for that excellent analysis there on the banking system. Some of the terms are a little difficult for our listeners who are not familiar with banking, but the bottom line is some of these other countries, their banking systems are experiencing housing problems, dollar problems, problems with their loan book. So over the next, I don't know, 6, 12, 18 months, we're going to start to see a lot of problems if the dollar rallies and the Fed keeps interest rates higher for longer.
Yeah, exactly.